Since 2020, I've been building a long-term portfolio focused on the strategy of dividend growth investing. This is where you buy companies who continually raise their dividend payments on an annual basis. They are companies with strong, dominant business models that continue to grow free cash flow over the long term. And my strategy has shifted over time. Originally, I focused a lot more on higher yield options, but given the fact that I'm young and have a long investing time horizon, I am much more focused on making sure my investments have a strong total return in the market. And I've shifted my portfolio to be more allocated towards companies which are growing their earnings and cash flows and thus pay a growing dividend payment. Because ultimately, a sustainable and growing dividend payment comes from a sustainable and growing business. And those growing cash flows and earnings are the same things that will increase the stock price over time. And since I started doing these portfolio updates, you have seen my portfolio change with this regard. And in that spirit, I just made a large change to my portfolio. I bought 2 new companies, Salesforce and Google, and I funded that by selling some of the stocks in my portfolio. So in today's video, I'm going to break down these buys and sells and ultimately give an update on my full 11 stock dividend growth portfolio. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. And before I dive into my portfolio, I just want to let everyone know I just had the biggest update ever to dividenddata.com, and that is our new AI investment research analyst. Think of this as ChatGPT, but designed specifically to help you research stocks, and it has much more accurate real-time data along with data visualizations and an interactive stock screener. And I am really excited for everyone to ask Dividend Data a question, so much so that I am starting a special sale for new members so that you can get 50% off Dividend Data. That applies to both the monthly and annual plan. The discount is locked in for life and there is a 30-day money-back guarantee. Use the promo code AI at checkout if you sign up via the web app. Just select your plan and enter the 2 letters AI in the checkout field where it says add promotion code, or click the link in the description and pinned comment to sign up via our newsletter and get the sale instantly, no promo code needed. And again, I am really excited for people to try this out. That's why I'm doing this 50% off sale. I want as many people to try this as possible, and there's a no risk 30-day money back guarantee. So try it out and let me know if you came up with any really great prompts. I'll likely use the tool a little bit throughout the video so you can get a sneak peek of what it's like, but let's dive into the portfolio update. So here you can see my current 11 stock portfolio. The current total value is $190.9 thousand with $122.7 thousand invested. That gives me an unrealized gain of $68.1 thousand, which is a 55.5% total return. And before I update all of my stocks holistically, let's explain the big changes that happened. I bought 2 new big tech companies that I think will be long-term dividend growth stocks, and I sold out completely from 3 of my smaller positions and had partial sales for some of my longer-term holdings, which I've discussed on the channel. So I sold my Starbucks for about a 30% gain. This was a very small holding for me, and I was never sure if it was going to be a long-term part of my portfolio. And really what happened here is they had a large sell-off, and I thought it was a pretty low-risk buy at that price. However, their business in recent quarters and expected for the next few quarters is not really doing that well right now. As you can see, analysts are projecting earnings per share to be down 4.4%, and that's for fiscal 2025. And despite that, Starbucks stock surged after they hired the Chipotle CEO to become the new CEO of Starbucks. And this entire spike was just from the leadership change with really no change in the fundamentals. And I do think the new CEO, Brian Niccol, is going to turn around the company because he has a very good track record as a CEO. But Starbucks trades at a relatively lofty valuation. They don't have the best balance sheet, and the company will do fine over the long term. I have no doubt about that. But part of investing in stocks is valuing the opportunity cost of having your money in one investment versus another. And as I was looking at this, it was pretty obvious to me that I would much rather own more Google or Salesforce than Starbucks right now. And that opportunity cost mindset was really what was going through each of these sales. So I sold out of my PepsiCo stock, and this is another company I think will do fine over the long term. It's a really solid company, but there's no doubt that PepsiCo is going to be a mid-single digits growth company over the long term. And while the dividend payment has grown at an 8% 3-year compound annual growth rate, but I don't know if that's sustainable because their payout ratio based on free cash flow has continued to grow over that time. I would not say that they're trading at a low valuation either. And when we start to compare, Google is trading at a lower PE ratio with far higher and more reliable earnings growth. I entirely sold my Kroger stock. And again, Kroger is a high quality company and one of the best grocery stocks you could buy, in my opinion. I would say Costco is a much better business because they have that whole membership based system, which I think is fantastic. But for regular retail grocery stores, Kroger is as good as it gets. And they've had massive dividend growth over the past 5 years with a 14.87% CAGR. Very sustainable with a low payout ratio based on both free cash flow and net income. But I do think free cash flow growth is slowing for Kroger, and a lot of their future will depend on the Albertsons acquisition coming up. And if I was looking at Albertsons stock, I wouldn't buy it. But in terms of a merger acquisition for Kroger, I think it makes strategic sense, especially when you consider Kroger can put their private label foods into the Albertsons stores. However, the FTC is trying to block the merger, so it is unknown whether it will continue. The exact timeline and outcome is up in the air at the moment. But I want to reiterate that these 3 sales aren't necessarily an indictment on any of these stocks. It's more coming at it from the opportunity cost mindset that I laid out. And then these other sales, I would actually say are a little more surprising. I made partial sales in both Disney and T. Rowe Price. And the reason why I say that's surprising is I would consider both of these stocks to be undervalued at the moment. And I do think they will do very well over the next year. But in terms of portfolio allocation, it really did not make sense to me that they would be above this new purchase of Salesforce and Google in my portfolio. And the actual main reason why I made this decision is because I had some gains from sales earlier this year that were going to impact my taxes. And basically what I was able to do is take my worst purchases of Disney and T. Rowe Price stock and take long-term losses on my worst buys. So this was when I was buying like Disney in 2021 when it was so overvalued. One of my biggest investment mistakes ever. So I basically can lock in $4.2 thousand of losses there. And I didn't have as much of a mistake with T. Rowe Price, but I did have some buys. So I was able to lock in $152 of losses. So that knocked out all the taxes from selling Chevron, Kroger, PepsiCo, and Starbucks. Also, I just realized as I was making this that I forgot to include one of the stocks that I sold. Chevron, ticker symbol CVX. I sold my entire stake in that. And again, this was one of my smaller positions. The majority of my oil and gas position is in ExxonMobil stock. And I actually had a far better cost basis on ExxonMobil as well. Also, I am not very bullish on oil and gas stocks at the current prices. I think they're valued pretty highly, especially considering that I'm expecting the price of oil to decline over the next few years, which has already been happening over the past year. But yeah, I sold my Chevron, Kroger, PepsiCo, and T. Rowe Price stock. So the sale of Disney and T. Rowe Price knocked out all of my taxes for Starbucks, PepsiCo, Kroger, and Chevron. And it even helped put some of the money towards my large Broadcom sale earlier this year, where that was a massive $12,000 gain. I do think Disney is undervalued at the moment. Their earnings per share and free cash flow are going to continue to grow over the coming years. And I think they're on their way to all-time highs on all metrics within the next year or two. And it's about 40% undervalued based on the consensus price target among Wall Street. And it's currently priced at the lowest price target on Wall Street. And I actually see a similar story with T. Rowe Price. Their earnings per share is growing, and in a year or two, I assume they will be at all-time highs on these metrics. It's 24% undervalued based on the consensus price target, and it is currently trading below the lowest price target on Wall Street. So I am still planning to hold my T. Rowe Price and Disney stock over the long term, but I feel much better about this portfolio allocation. So let's start with Salesforce, ticker symbol CRM. I bought 38 shares at a total cost of $11,118, which gave me a cost per share of $292.59. So this is one of the best enterprise software companies in the world, and they've seen just incredible growth of earnings per share over the past decade. And this growth rate is only accelerating in recent years. And here you can see their free cash flow per share, which is incredibly strong. And Salesforce has reliable subscription revenue and a lot of growth drivers that are going to help it over the next decade. So this free cash flow is only going to continue increasing. And what that means is that they're starting to repurchase shares. And in this past year, they started a dividend payment. The forward-looking annual dividend per share is $1.60, which gives it a 0.54% dividend yield. And that's extremely sustainable at around $384 million a quarter. And in Q1, they had free cash flow of $6.08 billion. And one of the things I like about Salesforce is they are a cash flow machine, and they have very low capital expenditures, so they generate tons of free cash flow. And this is at a time where all large technology companies are increasing their capex related to AI, but Salesforce isn't building their own models or data centers themselves, but they are riding the wave of those AI improvements and implementing it throughout their entire product suite. So they're letting all the other companies spend the capex, and they are just improving and creating new products and just raking in cash. Their capital expenditure last quarter was only $137 million. So from a pure financial perspective, I think Salesforce is set up to return a lot of capital to shareholders over the next decade. And if they choose to, they will have the capacity to be a high dividend growth stock. And Salesforce is actually an incredibly high quality business. They have very low risk of disruption, in my opinion, and that's due to them building an economic moat around their business. And I'll describe some of those factors right now. So they have an entire product ecosystem of various software solutions all within their platform. So this makes it that once you're in and you start using everything, you get really deeply integrated into Salesforce, and it can cover so many different parts of your business operations. And once a company has become highly integrated into Salesforce, there are massive switching costs. It takes tons of time, effort, financial resources. You have to retrain your workforce about what to use. And this makes Salesforce an incredibly sticky product. They also benefit from network effects in that they have an entire app store and developer ecosystem. So all the incentives are pushing in a direction where Salesforce will become an even bigger product ecosystem. In my opinion, Salesforce is set up very well for the future. In recent years, they've made acquisitions like Tableau, MuleSoft, and Slack, and all of these get integrated throughout Salesforce. And there are a ton of growth drivers for the future. And the number one you have to mention is artificial intelligence. And although they're not spending a lot in CapEx, they are investing heavily in AI capabilities. They just launched their new product, Agentforce. And this is basically a fully autonomous AI-powered customer support agent. And the great thing about Salesforce is that all these large organizations already use their software. Their data is already there. They're already in the ecosystem. So there is so much potential to add these AI features and increase the value that all these customers get. Because over the next 1 to 2 decades, the amount of work that's going to be done by AI agents is going to be insane. It's also going to help increase the productivity of all these employees in the organization. And as Salesforce increases the value from all the businesses that use their products, they in turn will make more money supporting these organizations. So it's this really great virtuous cycle they have going on. The other thing I like is that Salesforce is still a founder-run company, with Mark Benioff still being the CEO. Under his management, this company has grown massively. Since 2014, their revenue went from $4.1 billion to $34.9 billion in fiscal 2024. And in fiscal 2025, he gave guidance that they're expected to hit $38 billion of revenue. And also during this time, margins are expanding. In 2020, their margin was 16.8%, and they just gave guidance for fiscal 2025 of 32.8%. Their operating cash flow has exploded. In 2014, it was $0.9 billion, and their guidance for fiscal 2025 was $12.8 billion of operating cash flow. So Salesforce is a free cash flow machine. And I think that will lead to great total returns for investors over the long term. So Salesforce is now the 6th largest stock in my dividend growth stock portfolio, and I'd actually like to see it move up that list in the future. My other large buy was Google, ticker symbol GOOGL. I bought 61 shares at a total cost of $10,674, which is a cost per share of $175. So that puts it right below Salesforce at the 7th stock in my dividend growth stock portfolio. And Google is one of the most dominant companies in the world. And that actually is one of the problems for them. They're so dominant, they're being considered a monopoly, and both sides of the political aisle are considering to break them up, but for very different reasons. But this isn't going to be a political or monopoly argument here. I'm just going to focus on Google as a business. They are currently trading at a 22 P ratio, and their new annual dividend payment is 80 cents per share. That gives it a 0.47% dividend yield, and that's a very low payout ratio, by the way. I just did a full breakdown of Google earnings, so go and watch my video yesterday if you want more of a news-focused segment. This is going to be more on the long-term stock fundamentals. And with Google, they have such dominant businesses, whether it's search, YouTube, and Google Cloud is going to be a very high growth business in the future. And that's already happening. So they're expected to have double-digit growth in earnings per share over the next 5 years. And if they hit those earnings estimates, then by fiscal 2028, Google would be trading at a 12.2 P ratio at current prices. 12.2 for a company that is going to continue growing massively in the future. Revenue per share is growing at an 18.41% 10-year compound annual growth rate. Free cash flow per share is growing at a 20.55% 10-year CAGR. Alphabet has a fantastic balance sheet. They have $93 billion in cash and short-term investments, and they have deeply negative net debt, so they are in an incredibly healthy and opportunistic position to invest and make acquisitions. But acquisitions are a little bit of a problem for them because they are in the monopoly category. And because of that, they're returning more capital to shareholders via both share repurchases and their new dividend payment. So I think Alphabet is set up very well to grow into the future and be a dividend growth stock. And despite all the talk about competition in Google search, their advertising business is still growing significantly. Both Google search and YouTube ads grew 12% year over year. And let's not pretend that Google's some laggard in AI. The competition is very tough at the top. But Google has immense talent, and they also already have all of the distribution. We can't underrate how dominant Google search is. There's a reason the government's trying to break it up. The Google search experience is very good, and they're just going to integrate their AI advancements into that product. And with Google, AI is not only used to create new products, but it helps them improve all of their existing things as well. They've been using machine learning for years to optimize search results and the YouTube recommendation algorithm and all these various things. So continued investment and research in AI is only helping them improve their existing products. Not to mention the data advantage that Google has. YouTube as a data source, that has insane potential to be leveraged. And then when we get to YouTube, you also have to factor in that that is the best media business in the world. They don't have to pay any upfront money to get content made like Netflix. It's an entirely organic ecosystem, and it's basically crushing every single platform in terms of viewership, monthly active users, etc. And they've leveraged that audience to have YouTube Premium, which is a subscription service where you have no ads on YouTube, and then also YouTube TV. So they're basically going to become the main distribution point for cable in the future because everyone's already on YouTube. And then of course you have Google Cloud. I'm very bullish on cloud services over the coming years. I think AWS, Microsoft Azure, and Google Cloud will continue growing over the next decade at least. And I'm talking about growing at a high rate. Google Cloud grew revenue by 35% year over year. And as an investor, the main negative with Google, and this is also happening at Microsoft right now, capital expenditures are increasing massively. And that's because these are the big tech companies actually building the data center infrastructure for AI. So Google went from spending $8 billion a quarter in capital expenditures to $13 billion a quarter. So that's a $5 billion increase just year over year. But strategically, this is something Google and Microsoft and all these companies have to do. The risk of not investing that money is far greater than the risk of spending that incremental $1 billion. These companies are cash flow machines, have massive balance sheets and great cash positions. And I do think the decline of Google search is being dramatically overstated. Their competitive advantages are much larger than people are giving them credit for. So Salesforce and Google are the newest entrants into my portfolio, and I will likely increase my stake in both of them over the coming years. And as we look at my portfolio overall, I have 11 stocks, with my top holdings being Visa, Microsoft, the Altria Group, ExxonMobil, Apple, Salesforce, Alphabet, T. Rowe Price, the Walt Disney Company, Enterprise Product Partners, and Automatic Data Processing. My largest dividend payers are the Altria Group and ExxonMobil. These are the bulk of my current dividend income, and that's because I got a fantastic dividend yield on cost on both of them. So these are kind of core pillars of my portfolio I don't plan to sell in the future. My plan with these companies is to continue just raking in and reinvesting the dividends. From reinvesting dividends, my yield on initial cost basis is 11.23% for the Altria Group and 11.67% for ExxonMobil. And this dividend income will continue to grow from reinvesting dividends and dividend growth. All of these companies increase their dividend payments on an annual basis. And from this recent change in my portfolio, my annual income has been lowered slightly. So my new projected annual dividend income is $4,537. That's $1,134 a quarter, $378 a month, $12.43 a day, and 52 cents an hour. And here you can see the general pattern. Most of them are quarterly, with Disney being a semi-annual payment. November is a very low month for me at $83. That's because only Apple and Enterprise Product Partners pay then. And then December will be larger at $446. and January will be my largest at $620. And here you can see the growth of my dividend income earned over time. In October, I earned $560.82 of dividend income, and that was led by the Altria Group paying me $548 on October 10th. And I reinvested all of those to acquire more shares in the company. And so far in 2024, I've earned $3,941 in dividends. I was already up by nearly $500 on 2023. 2 more months to go. Now, I'm not going to do a full stock analysis on each of the companies in this account because this might turn into a 50-minute video, but I will be making lots of videos over this month, so make sure to leave a like and subscribe to the channel. And please make sure to try out my new AI tool on dividenddata.com. It really is incredibly useful. It is such a radical improvement to dividenddata.com. And that's why I'm doing this 50% off sale, so that I can have as many of you try it as possible. It's really good. So use the promo code AI at checkout if you sign up via the web app, or click the link in the description and pinned comment, sign up. There's a 30-day money-back guarantee, so no risk. And I'll link to my video where I kind of explain the basics of this AI tool. You have a dynamic stock screener where you can just ask and it will find all these different companies that fit the criteria you give. And you can filter by hundreds of different financial metrics. You can write entire reports on different stocks so you can learn exactly how a business makes money. There's all these interactive charts and graphs it generates. You can summarize earnings calls and the latest quarter as they happen. And this is sourced from the actual transcripts and documents so that there's way less hallucinations than there are in ChatGPT or any of these things. It uses real-time financial data, and of course you can ask it really any question you want. It gives you this just great starting point for research where you can really just save hours that you would do pouring through some annual report and various investor pages. I really have found it to be quite useful. So sign up and ask Dividend Data a question. Thanks for watching the video, and I'll see you next time.